What up, what up, what up, what up, what up, what up, people? How you doing? It's your boy D. This is D's Daily DD. Welcome back to the channel. I want to remind you I'm not a financial advisor. It's not financial advice, right? So don't take it as that. Take it for educational and entertainment purposes only. So yeah, guys, just a quick recap today, right? AMC had about 21.8 million volume, a price of 982 currently at the time of this recording, with it was up about 1.8%. Ape was up 0.59%, which was pretty much a flat day, not much going on there, with really low volume too at 5.7 million. Just to recap on that, I know you guys, some of you people like to watch the line, and some of you apes, really watch every movement or whatnot. I haven't been watching the charts lately that much. I've been trying to dig and find information, which today this is just going to be kind of a summary video. This is going to be a quick video for what's coming tomorrow, what I'm bringing in the videos tomorrow. I'm basically going to have to do like a part one and a part two for this information, because I came upon this document that really has a lot of good information and helped clarify things for me a little more. And it has to do with the Dtcc, the Nscc, the Dtc. I know that's a lot of C's and whatnot, but it has a lot of details. So today I'm not going to dive too deep into it. I'm kind of just going to go over some things that I highlighted. I downloaded the PDF, so I was able to highlight and make some points on it. But tomorrow I'm going to be going into more of a detailed video, part one, and then the next day I'll do the part two, because it's a lot of print, it's a lot of thought process, it's a lot of thinking, and I don't want people to get confused and so on it. And this article, right, it's pretty cool. It shows you things of like naked short selling, normal short selling, the clearing and settlement processes, and what that all has to do with our play with AMC. I know a lot of you here for the squeeze like I am, but we have to understand the mechanics, in my opinion, in order to get what we want. Obviously, you want the squeeze, I want the squeeze, we all want the squeeze, but it hasn't happened yet. And I can kind of, give you my thoughts on why it hasn't happened yet and where it's going and where we're at. But yeah, I'm still holding, guys. I'm holding for the squeeze. I'm not scared to sell. One way, or I'm not, scared to hold. One way that I look at this is, thankfully, Joe Biden, he paid off what I owed for, or is going to pay off, right? It hasn't happened yet, but he approved the process of clearing the student debt. Luckily, I qualify. So that's going to clear some money there, right? And that's the way I look at it now. I'm like, well, this money that I have invested, I could have used it to pay off those student debts. And that, either way, like I'm still winning right now, because that clears some debt. And now I can continue to hold more, confidently in this AMC play, because now I know I don't need that money for anything else right now, currently at this time. So yeah, just like I said, I just want to make it a quick video. Let's jump into this information, and shout out to all the subscribers. I'm here with y'all. I didn't make a video yesterday because I had a lot I needed to get done, and there really wasn't anything that I wanted to talk about or point out. The only thing that the news that came out yesterday was that the CPI was a little bit over, the inflation and all that stuff, which has to do with the overall market. And that's why you saw a big red day, in my opinion, yesterday with the market. But, we're going to move forward, and education is the goal here. So let's just go over this real quick. Like I said, I'm not going to, spend too much time giving you details. But this article here, let me zoom in a little more, really opened up my eyes even more. All right, so let me put my phone away so it doesn't distract me. And yeah, let's go. So naked short selling, as you should know, right, is selling a stock short without borrowing it and subsequently failing to deliver the stock at settlement. Now remember, Ape and AMC, well, more of AMC right now, has had a lot of FTDs, failure to delivers, in the past, and that always raised an eyebrow. Tomorrow we should get the new FTD report that is going to have the Ape FTDs, and we are expecting there to be a lot of FTDs on that report. And we know that it's, caused much sensation. Critics claim that naked short selling is used in abusive trading strategies and manipulative attacks on companies. Right here too, like I said, I'm really going to give you more of a breakdown tomorrow with the whiteboard. So, if you want to come back tomorrow and watch that video, it'll be part one of this whole article, or this, what I stumbled upon here. Disgruntled Wall Street veterans, directors, and shareholders have blamed naked short sellers for the collapses or near collapses of several companies and gone far to establish organizations as, against campaigning against naked short selling, the National Coalition Against Naked Shorting. There you go. So this naked short selling problem has gone on for a long time. It's not just with AMC. But here, naked short selling, not all naked short selling is abusive. Some naked short selling occurs unintentionally when a short seller, in line with the current regulation, locates shares to borrow or has reasonable belief. That's the part that I highlighted here because it's just amazing that they can, still borrow, or, they can still sell a share if they have reasonable belief that the shares can be located and borrowed. But for some reason, it is unable to borrow the stock in time for delivery. Further, some naked short selling is due to market making. If FTD occurs when the seller of a security does not deliver the security to a buyer within the standard 3-day settlement period. This is what's interesting, right? And fail volume decreased from 2004 to 2007 and then increased rapidly during 2000 and 2008 and declined substantially at the end of 2008. What's happening right now, that's the same thing that's happening right now. There's signs again. That's why people talk about a market crash. Recently in a lot of stocks, there has been an increasing amount of fail to delivers. And it's a sign, right, of also what happened like back in 2008. You can go look at the chart right now, how there was a massive amount of shorts right now in the market. Let's go down. This compares your traditional short selling versus your naked short selling. In naked short selling, the seller does not borrow the stock. As a result, fails to deliver the stock to the buyer at settlement. Remember when on June 28th, there was 9.6 million fails to deliver on AMC. That was a lot of shares that did not, get delivered. And that's where those FTDs came from. Yeah, this is like a 14 page document. So that's why I'm trying to just, skim through it. My goal is to make this video 10 to 12 minutes. When borrowing costs are high, market makers sometimes choose not to borrow and instead naked short sell. This is economically equivalent to borrowing shares at a zero fee, zero rebate equity loan, plus the expected cost of being forced to buy back the stock and deliver it, a process called buying in. Now, we are all expecting and waiting on buying in for that to happen. That would basically be when they are forced to buy the shares in order to close out the short position. Because naked short sellers do not borrow the stock, they can theoretically sell an unlimited volume of stock into the market, driving down a share price. Have we heard of that before? I think so. Through its subsidiaries, I'll say the whole name. The Depository Trust and Clearing Corporation provides clearing, settlement, and information services for equities and other securities traded on the U.S. financial market. The National Securities Clearing Corporation, which is the Nscc, and the Depository Trust Company, the Dtcc. So it is a corporation and a company. All right, so they're a third party. That's why I'm going to break this all down on the whiteboard so it'll be more clear tomorrow. But just to give you some letters right now, there's a lot of CCs and explaining who they are, but they are not parts of the government. They are overseen by the SEC. And that's where I think a lot of people get, confused. But trades are netted in the continuous net settlement CNS system. The Nscc has roughly 4,000 participants and is regulated by the SEC. Today, these are largely electronic records, although the Dtcc is also a store of physical certificates. All right. Now, in my opinion, guys, they're the ones who have all the information, right? They're the ones who know exactly how many phantom, synthetics, extra shares there are of AMC, and they know who is the broker that is causing these FTDs. They're the ones who have all in their computer systems. From my research, it seems like the Nscc, the DTC, and the Dtcc, they have the information, and they're the only ones, them and the brokers. There's nobody else that can give you that information. Let's go back. So the DTC does this by debiting and crediting participants' securities and money settlement accounts held at the DTC. And it's all electronic book entries. All right, that's what we need to remember, that nowadays it's electronic. Clearing participants include brokers, broker-dealers, banks, and insurance and investment companies. Let's go back up. Most of the U.S. equity trades are cleared and settled through the Nscc's continuous net settlement system. They're the ones, that's what I'm saying, they have all their information in that system. Nscc steps in the middle of the trade and assumes the role of the counterparty for both the buyer and the seller. And it's the T+2. Because the Nscc is the counterparty to each trade, a participant with a short position in a particular stock can be thought of as owing the Nscc the short amount of that stock, and a participant with a long position can be thought of being owed the long amount of that stock. An algorithm run by the Nscc determines which of the following, or which participants with long positions, participants that are owed the stock by the Nscc due to be settled that day, will receive stock. And it's the order, the algorithm, the way it works. They have their own algorithm. Remember, we've heard of that a lot, right? There's a lot of algorithms out there in the markets, but it's age of position within a priority group and random numbers within age groups. Now, again, I know this can be a lot, and it's a lot of text and a lot of information, but I will break it down in more detail. Right now, I just want to give you a quick summary. You know, what happens when a fail occurs? If a participant is unable to deliver on their net short position stock owed to the Nscc, the position is called an FTD, and the short position remains open. When participants fail to deliver the stock, the Nscc receives less stock than it owes and consequently may not be able to deliver the stock to all the positions or participants with long positions. Now, something new that I learned, when the Nscc is unable to deliver to the long positions, that's called an FTR, fail to receive. And you can think of it as an IOU from the Nscc. We've heard that information over and over, right? So we have been able to prove there is synthetics, IOUs, whatever you want to call them, out there. Now, here a quick, sentence. Critics of the Nscc claim that a potential danger of the system of marking to market, that it causes and can cause, more damage than good, basically is what it's saying here. There is the stock borrow program. And although the Nscc states that the purpose of the stock borrow program is to cover temporary shortfalls in the CNS, there is no time limit on how long the Nscc may borrow stock from its participants. The stock borrow program has been criticized for allowing naked short selling to persist. So it has been criticized. All right, buying in. I don't want to spend too much time on buying in right now. I will break that down later in tomorrow's video and the next video. That's why I think I have to make it a two-part video. But let's just wrap this up. So buyers that receive an FTR during settlement rather than the actual share are unlikely to be aware of this. And then finally, the U.S. clearing and settlement system does not provide any significant disincentives for naked short selling. As we have said before, right, like there is not big penalties. There's no, reason, like the short sellers and whoever does the naked short selling, they still continue to do it because the penalties are not significant. Now, this is a chart going back to 2008, 2009, showing you the fail volume. The red line is the fail volume as it increased, right, as it got closer to that crash. And then the daily volume is the green. And like I said, there is a chart right now that, other YouTubers have showed in their videos recently, showing that, there is a large amount of FTDs, a large amount of short sellers right now in the markets that can get tore up. This is a little breakdown. So the investor that wants to buy sends it to his broker, and then the broker sends it to the stock exchange, right? They have to match the trades. It gives you a little breakdown. A seller investor, he's the one who also has to sell it, and they have to match the trades, right? And again, the Nscc, this is what we're talking about, the Dtcc, they're the ones who handle all these transactions. Here's some literature, some notes, and that's all I got. So yeah, guys, like I said, we're going to break this down and jump into it in the next couple videos. So I hope to catch you in those videos. Thanks again for stopping by. I hope you have a great, rest of your day. And I will be linking this information down below in the description if you want to start reading it, so we can, figure out and learn and see what's going on here. But catch you guys in the next video. Peace out.